Up to this point, when we have created a balance sheet, we only have three categories: assets, liabilities, and owner's equity. This chapter, we are looking at expanding those categories and classifications so that we have more detail on the balance sheet. Up here, I have Apple's most recent balance sheet, and you can see that there are more categories or classifications than we have previously used. The first one that you'll notice is current assets. You'll also notice the keyword current when we talk about current liabilities. So the question then is, what does current mean? Current means either 1 year or one operating cycle, whichever is longer. So the longer of those two is what current is. So for current assets, that means, are we going to use it up within 1 year, or is it going to turn into cash in 1 year? Whatever it is, it's 1 year. Current liabilities are we going to pay it off within 1 year? Now, there is this nuance of one operating cycle, whichever is longer. For almost all businesses, 1 year is the actual definition of current, but we have to put this nuance in here for operating cycles because not all businesses operate on like a 1 year cycle. For example, a construction company that does stadiums, that takes a lot longer than 1 year to do. So an operating cycle is how long does it take us to go from we have our initial cash, and then we will do something with that cash. Sometimes that is buying inventory. And then we sell that inventory, and then we collect it from the customers, which then turns it back into cash. So an operating cycle is how long does it take us to use our cash and then do something with our customers and then turn it back into cash. For most companies, that is a very short time period, and so that's why we say current is just 1 year. There are some businesses that this cycle takes a lot longer, such as construction companies, where they take their cash, they buy the materials, they construct the stadium, and then they collect from the customer, and that can take multiple years. So for those few businesses, then you have to look at the one operating cycle. So their accounts receivable, even though the customer isn't going to pay for 2 years, that still might be current because we are essentially working on the current project. But again, we're not going to look at that too often in this class because for well over 90% of businesses, the definition is just 1 year. All right, so again, current assets means we will either use it up within 1 year or it will turn into cash within 1 year. So cash is already cash, so that is always current. These marketable securities that they have here, those would be short-term investments, meaning Apple is planning on selling those within a year. Accounts receivable, we're hoping we're collecting those within 1 year. Inventory means we hope to sell it within 1 year. And then there's other various things, could be like prepaid insurance or prepaid rent, where we are going to use those things up within 1 year. Current liabilities, typically we have accounts payable. We usually owe that stuff within 1 year. Deferred revenue is when we got the cash and then have to do the work later. In the terms of like Apple and retail stores, this is often gift cards. So we buy the gift card up front and then Apple has to give us the product later. So that's probably their deferred revenue. They have some other short-term debts here as well. So all of these things they are planning on paying within 1 year. All right, we are also going to see other classifications. If it's not current, well, it must be non-current, or we also refer to this as long-term. So you will see both terms used, either non-current or long-term. With liabilities, this is simple. It's just, well, if we're not paying it within 1 year, we are saying it's going to be paid later than a year, so it's long-term. Those are the only two classifications on the liability side. It's either current or it's long-term. That can get a little complicated because some long-term liabilities have a current component to it. We're not going to look at it too closely in this chapter, but just to introduce you to the concept, I have a home mortgage. That mortgage is going to be paid out over 30 years. And you say, well, 30 years, that must be long-term. The trick, though, is that some of that mortgage has to be paid back within the next year. So part of that mortgage is current and part of it is long-term. So just be careful with those long-term liabilities. There actually might be a short-term component to it. All right, with going back up to the asset section, under long-term, we actually have 3 different categories under long-term. One is long-term investments. And Apple doesn't have 3 different categories for these 3 categories, but on your homework, you are going to have to distinguish between the 3. The first is long-term investments. These could be stocks or bonds or even land that you bought that you're not using in your business that you're planning on selling. So some sort of investment that you're going to hold on to longer than a year. The second is property, plant, and equipment, sometimes called fixed assets. So these are long-lived assets that are used in your business, and they have to be tangible, meaning that you have to be able to touch them. They're actually something that you can touch and feel. So you can think of buildings, furniture, computers, land, equipment. So all of those things are tangible and long-lived and are used in the business. So if it meets those 3 definitions, then we put it under property, plant, and equipment. The last one is intangibles, and I'm guessing that's what Apple has here in other non-current assets. Intangibles is the opposite of tangible. You can't touch it, you can't feel it, and so but they still have value. You still paid something for it. Examples of these would be patents and copyrights, trademarks, sometimes even customer lists, things of that nature. So from here on forward in the class, whenever we put together a balance sheet, we have to put it together as a classified balance sheet. So all of our assets, instead of just bunching them all under assets, we have to say, are they current assets? Are they long-term investments? Are they property, plant, and equipment? Or are they intangibles? And then when we look at the liabilities, we have to divide those up between, are they current or are they long-term? So that's an overview of the classified balance sheet, and you will see this in different formats. So just keep in mind that you have to put all of the accounts on the balance sheet in one of those categories.